It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. So far this year, industrials are lagging behind the broader market index after delivering positive returns in 2023. Is now the time to buy into the sector? And what's the best way to play it? I'm here with Brian Mulberry, Zacks Investment Managing Client Portfolio Manager. And let's dive right into it. It depends on where, I guess, is the short answer here. But let's talk about your buy here, and that is 3M. Interesting timing here because the company did just report and the stock reaction was not fantastic, but you see some reasons for optimism here. Let's start with supply chains.
Yeah, absolutely. So after the earnings yesterday, what we saw is a little bit softer guidance coming out from the management team, and that's had pressure on the stock so far. But what we like long term is 3M has improved its supply chains to the point where they may save as much as 38% on margins, and over a long period of time, that gets added back into the balance sheet. So the lower cost of materials in doing business is adding to profitability. And so we see organic growth over the next 3 years, much better than what they've seen over the last 3 years. So this is going to add back, I think, a lot of value to the price per share.
And let's talk about the cash flow too, because that's something else that you're looking at here combined with that margin story.
With that strong cash flow position, 3M has been very shareholder friendly over the last several years. They've actually added back significantly to the dividend, and they're buying back shares as well. So they're doing something, I think, very productive with that strong free cash flow position. So now you've got a dividend yield north of 5% on a company that has a PE under 10. So in terms of putting, productive capital to work, this is a really good valuation.
Yeah, and they just, as you said, boosted the dividend again. So what did you say the yield was?
A little over 5% now. They added back $1 per share to that dividend over last year, again, showing really strong free cash flow management coming off the balance sheet.
And presumably, if rates start to go down, that becomes even more attractive.
Absolutely. So it's one of those few stocks that's out there that's actually equaling what you're getting at a money market account right now. 5% yield is important. If I'm only getting 3 or 3.5, that's not as attractive as I'm still getting a really good risk-free rate in savings. But now, again, a really strong multiple in terms of earnings growth and a good, strong dividend yield at the same time. Again, productive capital long-term as an investment. That's why we like this name so much.
So we like to ask people what could go wrong, right? What's the sort of bear thing that could happen here? Weakening mask demand, which we've already been seeing here, and then something happening on the expense side as well.
Of the 4 business units that 3M manages, healthcare is definitely the weakest and has the weakest outlook. And that's just a year-over-year comparison when you consider the fact that we don't have that strong of mask demand for the obvious reason that we don't have shutdowns and mandates and things of that nature. But one of the great things about 3M is the management team has identified this weakness, and they're going to spin off the healthcare segment into its own standalone company later this year.
Gotcha. And then possibly if there is an increase in commodity prices, that could be problematic for them as well?
Sure, absolutely. But again, we have kind of a little bit of a yin and yang there. If rates do come down, it will offset the strength of the dollar. That could help actually be a little bit more of a tailwind than a headwind. But again, the balance between all of that and the strong bottom line margins with all of these effects in place is why we like the stock long term.
And just to be clear here, you guys have got a pretty big, you're implying a pretty big gain from here. 220 is your price target. You're looking pretty long-term. I'm not used to seeing a 3-year price target from people.
Sure, absolutely. And that's one of the biggest things about us at Zacks is that we're long-term investors. We're not short-term traders. And the price action this week shows that. What we're seeing here in our price target is the effect of that organic sales growth. There's a swing of 5% in organic sales growth because of those cost savings. That gets piled back into the balance sheet, and that's why we see there will be more interest and upward price pressure over the long term on this stock.
Okay, and just quickly, do you own this stock?
We do own this stock.
Okay, gotcha. Now let's get to your goodbye, the one that you don't like. In the same industry, we're looking at RTX, another industrial, and another industrial that just reported as well. It had a better reaction, but let's talk through why you don't like this one. First up, FX headwinds.
Yeah, absolutely. And so what we know about Raytheon, because we used to own this, and we actually said goodbye to it in our portfolio recently as well, mainly because a big part of their private business is making aircraft engines for Airbus. That means they have a European client that's priced in euros, and with a strong dollar, that's adding to pressure on their profitability long term. Now, we do believe that Raytheon is a good company. They get 60% of their revenues from government contracts. They're not going anywhere, but we're talking about valuations today, a PE of around 18 and only a yield of around 2.5. So how is your capital being treated? Not nearly as well as it would from a company like 3M.
And let's also talk about perhaps their debt burden and the effect. Yes, rates might be moderating a little bit, but they're still higher than they've been for the past few years.
Yeah, absolutely. And that is showing, and we're starting to see that weigh on a lot of balance sheets as some of that debt has to get refinanced as it rolls over. Even as rates are expected to come down, we haven't seen it materialize yet. And so that cost of capital is rolling off the balance sheet, squeezing their bottom line margins as well.
And then finally, Chinese sanctions hurting a lot of different kinds of businesses, including, let's go back just one here, sanctions on Taiwan. So that means a market that maybe could be open to RTX is not going to be as open.
Exactly. And so it's one of those things that, again, further weakens the balance sheet position and over the long term doesn't provide as much return of capital to shareholders, which is why we think there's going to be a little bit softer reaction. Still probably largely positive over a long period of time. But in terms of the growth rate over 3 years, we simply don't see RTX catching up to a company like 3M.
Okay, what could go right here in this case? Aerospace could just generally improve?
Absolutely. So we know that air travel has come back and beyond what pre-COVID levels are. With those conditions underlying, we know that there's going to be huge demand for new equipment, especially wide body equipment, and we're seeing overseas travel pick up enormously as well. The Pratt & Whitney segment of Raytheon supplies great big engines to those airliners, and we would expect that if demand were to continue at these levels, that we would see production ramp up. That is one of the most profitable segments of their business. So if we are wrong and we see that pick up, that's what would be a major tailwind for Raytheon.
Gotcha. All right, so let's sum up here. And by the way, the 3-year price target there is 140, which is, you know, doesn't imply upside.
Relative growth of around, 30% versus perhaps a doubling of 3M in that same 3-year period of time. Again, just why you would want to own it as a long-term investment, not a short-term trade.
It's all relative. So let's sum up your position on these two. You're telling investors to buy 3M based on supply chain improvements, solid free cash flow, and that boosted dividend. On the other side, you say maybe avoid RTX right now because of those foreign exchange headwinds and high interest rates weighing on the company's balance sheet. Thanks so much. Really appreciate it, Brian.
Thank you.
Thanks for coming in. All right, that does it for Goodbye or Goodbye.